strength or the severity of that recession, financial crisis, these are all the same words, will be in proportion to how much debt is going to default and how many people that thought they had money no longer have any. And this is going to be worse than, or better, depending on where you're positioned, right? It's going to be worse if you don't have money. It's going to be better if you do, than any other recession that we've ever seen or experienced, I think, in American history or even world history, because we've never done anything like this. Central banks print currency a lot faster than they can possibly accumulate any gold. And I'm not saying they're not accumulating gold, but sometimes, and I don't know about India's case specifically, but when gold bugs tend to talk about central banks buying gold, and then they're, this is going to raise the gold price and we're going to be rich. I mean, if you look at a central bank like Turkey, they buy gold, they sell gold. They buy gold, they sell gold. It goes up and down. It's like, it's crazy. And who wants the Turkish lira? Nobody wants it.
In today's news recap section of the episode, gold stalls ahead of Fed rate decision, focus on 2025 outlook. Gold prices were little changed on Wednesday as investors remained cautious ahead of the U.S. Federal Reserve's policy decision, which is also expected to offer guidance on its outlook for next year. Spot gold inched up 0.1% to $2,649 per ounce. Gold price actions are less of an arrow, more of a feather at the moment, and sort of drifting on book squaring, independent analyst Ross Norman said. Attention will be on Fed policymakers' updated economic projections for 2025, released alongside the decision, particularly regarding how much more rates are expected to be eased next year. Markets are pricing in a 95.4% chance of a 25 basis points cut in this meeting, expected to be announced. There's only about a 16.3% chance of a reduction in January. If the dot plot points to 2 cuts or less for 2025, markets would read it as hawkish, and the U.S. dollar could see another round of strength, OCBC analysts said in a note. A stronger dollar makes greenback-priced bullion more expensive for holders of other currencies. Meanwhile, the Bank of Japan, Bank of England, Riksbank, and Norges Bank will deliver their policy verdicts later this week. Investors will also pay attention to Thursday's U.S. GDP data and inflation data due later this week, both of which could impact bullion demand. We expect gold to build on its gains in 2025, UBS said in a note, adding that central banks should continue to accumulate gold as they diversify reserves, while investor demand for hedges should rise further, boosting inflows to gold exchange-traded funds. Now we'll show you more clips, but first, smash the subscribe button and check the pinned comment to get yourself the best VPN deal on the market. You'd be crazy not taking advantage of NordVPN to safeguard your privacy at these prices. Enjoy the episode.
Accidentally on Friday, actually, I mean, I track the yield curve, I track the spread, but I don't check it every day. So I knew we were heading close to some people say uninversion, but that sounds kind of off or unprofessional. So I guess the better way to put it is a normalization. Or you could even argue that it's not quite normalized yet, because even a yield spread or a spread above zero, by which we mean that short-term yields are lower than long-term yields. Like it costs more interest to loan out to borrow money for 10 years than it does 3 months, which that's what it should be, right? Because we're all mortal and we all have a limited amount of time. So the more time that you are separated from your money, the more you should be compensated for that. So the spread between the 10-year and the 3-month treasury bills and treasury notes is now, I'm looking at it on Fed right now, it's 0.06. So you get 0.06, you get 6 more basis points of yield for lending out your money for 10 years than you do for lending it out for 3 months, which this is not quite normal, but it's above zero at least. It acknowledges that at least we're mortal, but if you only get 6 more basis points for lending out money for 10 years than you do for 3 months, then I guess, our lifespans would be like maybe 2,000-3,000 years, something like that. Maybe more. I mean, I haven't plotted it on a calculus integral, whatever. But the point is, okay, getting back to Earth here, or wherever it is we are. We're back above zero. So what I did is I took a look at the 10-year minus 3-month yield spread, and I looked at the recession shaded areas. And I'm looking at the chart right now, which is why my eyes aren't looking directly at the camera. And the last 3 recessions, we have 1990, 2001, and 2008, which we all know about. It's somewhere between 3 and 6 months from when the spread goes back above zero to when the next recession is triggered. And the question that people ask me is this organic or is it causative? Is it that that's okay, I'll just leave it there. My helicopter bin fell off. Maybe that's ominous. Maybe that means that we're ending this printing cycle. Could be. So is it causative? Is it that the yield spread goes above zero and therefore that triggers a recession or triggers a financial crisis? Or is it just correlative, right? The fact that money is tightening means that interest rates are going higher. And it's the tightening of the money and it's the tightening of bank lending, right? If interest rates are higher, less people are going to borrow money, and then you're going to have less grease in the wheels of the Keynesian economy. And then that's when debt starts to default. Then you have the slowdown, then you have the crash, and that's when all purchasing power kind of flows into gold and silver. Whether it goes up and down in dollar terms is a separate issue. And I don't think it's causative. I think it is it's just correlative. That when you start seeing the yield spread go above zero and go higher and higher and higher, that means that interest rates, that longer term interest rates are rising, which means money is getting tighter. It costs more to borrow, which means money's running low, right? So it's sort of like it's like a chicken and egg question. When you ask the question, when the Fed cuts interest rates, right? Does that cause a higher money supply, or does the bigger money supply cause the cut in interest rates and the Fed's just following it down? And it's really a chicken and egg question. But what we do know is that when longer term interest rates are higher, then the money's starting to run out. And finally, that is what is happening. And judging by history since 1990, which is really when the fiat system started to heat up, right? If we count the beginning of the fiat monetary system in 1971, then really from 1971 to about 1980, 1985, the central bank was still trying to gain control of the system. It didn't really have it yet. And then by 1980, 1985, they were able to gain control of it as to where we are now and get things going. And now we're at the end of the ride here. So counting from 1990, when the fiat system, the fiat dollar standard, as we were all familiar with, started to really gain some strength and gain some momentum. Then from that system on, we have about historically 3 to 6 months before the next recession is triggered, and the strength or the severity of that recession, financial crisis, these are all the same words, will be in proportion to how much debt is going to default and how many people that thought they had money no longer have any. And this is going to be worse than, or better, depending on where you're positioned, right? It's going to be worse if you don't have money. It's going to be better if you do, than any other recession that we've ever seen or experienced, I think, in American history or even world history, because we've never done anything like this.
In today's news recap section of the episode, gold price faces strong headwinds ahead of Federal Reserve meeting. After testing resistance at $2,700 at the start of the week, gold is once again on the back foot as stubborn inflation takes its toll on expectations surrounding the Federal Reserve's easing cycle. The precious metal received a much-needed boost earlier this week as investors reacted to news that China's central bank resumed buying gold. After a 6-month break, data from the People's Bank of China showed it purchased 5 tons of gold in November. According to many analysts, the data underscores China's significant role in the gold market and highlights healthy central bank demand heading into 2018-2025. However, the precious metal continues to face near-term volatility as attention now shifts to the Federal Reserve's monetary policy meeting next week. According to the CME FedWatch tool, markets have fully priced in a 25 basis point rate cut following the Fed's final meeting of 2024. There is growing uncertainty regarding the duration of the current easing cycle in the new year. The gold market began selling off this week after the U.S. Labor Department reported that its headline producer price index rose 0.4% in November, following October's unrevised 0.3% reading. Over the last 12 months, headline wholesale inflation increased by 3.0%, well above the consensus of 2.5%, and October's upwardly revised 2.6% reading. The rise in wholesale inflation suggests that the threat to consumer prices remains elevated, which some economists say will discourage the U.S. central bank from raising interest rates. In its outlook earlier this week, analysts at Wells Fargo said they expect only one rate cut next year. Similarly, Bank of America recently forecasted just 2 rate cuts in 2025. Naeem Aslam, Chief Investment Officer at Zay Capital Markets, said gold. Investors should prepare for potential weakness next week as the Federal Reserve pares back rate cut expectations. Another analyst, Lukman Otanuga, is more neutral on gold, noting that the precious metal is caught in a tug of war. He added that while a hawkish Fed is negative for gold, the yellow metal still retains plenty of bullish momentum. Now we'll show you the best clips of the latest interview. But first, hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you keep your data private, especially if you're browsing investing-related material. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
It's not exactly causative. Right. So I'm looking at the chart here, back in Fred, and the yield curve inverted, at least on the 10-year minus 3-month spread. It inverted on October 25th, 2022. So we're 2 years and 2 months into this. And the next longest one was to 2008, right? And I'm zooming in on that right now, and I'll tell you that the inversion lasted from July 14th, 2006 to June 4th, 2007. You could stretch it out because it kind of wobbled up and down for a few more months after that. So the latest day is August 10th, 2007. So we're talking about a year plus change in months. So that was 2008. Before that, it was even shorter, and before that, it was even shorter. 2000, I'm looking at it right now, was from June 2000 until January 2001, so less than a year. And before that, in 1989, it was from May 1989 until November 1989. So about what is that? 5-11. That's about 5-6 months. So about the same as 2000. The analogy that might help you understand this: why should it be that a yield curve inversion that is longer would yield to a bigger financial catastrophe or a financial crisis? And if you think of, I got this analogy from my friend Phil Lowe of the Bitter Drafter. I think Dunnigan had interviewed him a week or two ago, and he's up and coming. He's a good friend of mine. He thinks a lot like me, or I think a lot like him. And he used the analogy of throwing a ball up in the air, to imagine or to make it look like you've broken the law of gravity, right? If you throw a ball up really high in the air, it looks like there's no gravity because it's going up, right? Except what it's slowing down. It reaches its apex point and then it starts falling. And once it starts falling, the higher you throw it up, the harder it's going to come down. So an inverted yield curve is basically saying everybody is immortal. Everyone can borrow and lend money at phenomenally low interest rates because since we're never going to die, what's the point, right? That's denying our mortality. And you can do that for a while. You can pretend that you're immortal and you can do crazy things and maybe you'll survive for a while. But eventually, your energy is going to run out. You're going to get old. Your limbs are going to shut down and you're going to die. Well, all of us are. And so the longer we deny our mortality, the stupider we're going to do things. We'll do crazy drugs. We'll take crazy risks. And we could end up dying early doing something stupid. So that's the economic equivalent of that is living in an economy with a negative yield spread. Right? It makes you take stupid risks that you shouldn't be taking. Like, for example, buying assets that don't exist. Everybody knows what I'm talking about. This it's nuts what's going on. Or starting wars that you can't afford to pay for. There's wars all the time, and starting potentially World War III in a bid to keep the economy going. I mean, you can't get much crazier than this on a planetary scale. So thank God we're out of this negative yield spread, which is causing not just monetary insanity, but academic insanity, all this money going to every crazy place in the economy that you couldn't possibly imagine would exist. I always bring the example of like peak insanity is like child mutilation surgery. Those things are funded by inflation, by government. It's just, this has got to end. And it's going to end by among other things, the yield spread going positive. If we're going to plug it back into basic economics.
If you resonate with Rafi Farber's perspective on the looming collapse of the US dollar and the critical role of stacking gold and silver as a hedge against economic uncertainty, we'd love to hear your thoughts. Are you preparing for what's ahead by stacking? And more importantly, are you bullish on gold and silver for 2025? Let us know in the comments below. Your insights could inspire others in the community. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.